Welcome to the Burgess Rawson from CBRE Podcast. Welcome Matthew Wright, Yosh Mendis and Jamie Perlinger.
Good morning.
Good morning. Thanks for having us.
Well, what an incredible year it has been. CBRE Metropolitan Sales has achieved an incredible $3.268 billion in transactions. Of those, $1.7 billion were performed under the Burgess Rawson from CBRE brand. What a year. Yosh, what was your standout moment in 2025?
Oh, there's been a few. I think we were talking about this before. I think for me, the auction of the 7-Eleven and McDonald's at Greystanes was up there. Is an asset that doesn't come to the market frequently. Yeah, we never see Sydney McDonald's come to the market ever. To have an integrated McDonald's and 7-Eleven investment, 2 freestanding buildings on the one title on a highway location in Sydney, it basically ticked all the boxes, and it performed that way at auction. It was a real true testament to the asset class. We sold it for $18.4 million at 3.96% under the hammer. We had multiple bidders across Australia bidding for that asset, and it performed exceptionally well.
And those kind of yields really talk to, our two favourite categories, of course, fast food and fuel and convenience. But we did see fuel this year really contract. Jamie, why is fuel contracting this year?
I think it's the fundamentals. It comes back to the fundamentals of these assets. You've got your lease term, your tenant being either ASX listed, and even now international companies coming in. They're future-proof sites. They're on highway sites, good locations, underlying land value. And most times, they're paying, the tenant's paying all the outgoings. So you've got key fundamentals, really.
And what changed in 2025 for fuel? Did we have new entrants to the market, or why are investors suddenly so interested in fuel? We saw different investors, didn't we?
Yeah. I think the strength in the retailer itself. You see Viva buying OTR out of Adelaide just shows the strength of that business. You've got 7-Eleven transacting as well to the Japanese business. And just, I think people are seeing more and more strength behind these covenants, really, really important. And then we've got Sinopec now coming into Australia as well. They've got 4 sites here in Victoria, which is a Chinese brand. They've got something like 30,000 retail sites throughout Asia. So they're coming. So I think we talk about EVs and things like that, but I still think the fundamentals are in the property and the strength of these tenants.
Mm. And in 2025, we certainly saw some of the hype about EVs abate. And I think that also started to bring investors back. They kind of, we've had low levels of sales, low adoption. Fuel is around for the long term. And especially when coupled with fast food or great leases, the investors want them.
Yeah,
absolutely. And I think the investor uptake and confidence with that sector continues to grow, and even new entrants into the market coming through. But even just existing investors just continually like investing in it. Yesterday I was at lunch with an investor that we've sold 7 service stations to, and he goes, well, I'm ready for the next one, probably the next 6 months. He's just going to keep acquiring. And I've actually asked him what his fascination with convenience retail is, and his view is that in the future, he believes, whatever happens with the sector, between convenience retail, EVs, he says his land holdings are going to be the ones that they're going to need. So his view, he's got a lot of confidence in the land as well as buying these big global tenants.
And what comes to mind is just how credible these sites are. From my point of view, the OTR lease was one of the best I'd seen this year. What happened with Moonee Ponds, and why was it so highly attractive and had so many bidders?
Well, it comes back to the tenant being Viva, being OTR, one of the best convenience retailers in the market. Triple net lease. The tenant pays all the outgoings, including multiple holding land tax, which is huge for any investor. Like Yosh was saying with his client owning 7, you've got a lot of land tax, and they pay the multiple holding on it. In a city location, there's about 5 Ks from the CBD. It ticks all the boxes.
And Yosh, obviously with Greystanes, we were co-located with a McDonald's, but let's talk about fast food as freestanding. We sold $201 million worth of fast food this year. It is the absolute darling of the industry.
Absolutely.
What are you seeing in relation to fast food? Are yields still holding sharp, and are they getting sharper, or where are we at?
Yeah, so fast food was probably one of those asset classes that were just unaffected through any of this process, through interest rates. We really found that fast food was the most resilient, and historically it always has been, and it's why people love it. It's held its rates on cap rates. We've seen compression with particular brands. We've seen the introduction of new tenant covenants, which has obviously made that industry space quite competitive, even for tenants. The cost of construction is pushing these rents, but also competition for these spaces for tenants is pushing rents.
I've never seen fast food rents come up so quickly, really, in the scheme of things in the last kind of 2 years. And GYG as an entrant to the market as well has made a huge change. But Matt, you were talking earlier before about the change also to Starbucks. So what is our pecking order now from a yield to tenant ratio? What's our order and what should I be looking for in 2026 in fast food?
Yeah, we were talking before. I mean, Starbucks is something that has really surprised all of us, I think. It's made a huge comeback into that drive-through space where traditionally they were more strip retail locations. It's a debate, but clearly Macca's we all love. I think that's still number one. You spoke about Greystanes, but St Albans was fantastic this year to crack a 3% yield in Victoria for the first freestanding McDonald's. So that's my number one. Number two, I think it's still Hungry Jack's and KFC. I think they're around the mark together. And then the emergence of GYG and Eljana. I know we're talking about GYG rents, but Eljana rents are getting up there too. But I think their business model, which we've spoken before about, that vertical integration is really, really coming strong. And then Starbucks, I think they need to sit somewhere around that.
And Eljana was something that Victoria hadn't seen a lot of. And Jamie, you brought Eljana to market this year with an incredible result. How was the investor feedback and acceptance of Eljana in Victoria?
I think, as Matt was saying, I think the vertical integration of their business, and I think the sales part of that, we had to teach the buyer about the business as well. I think a lot of the times they didn't know who they were, but I know they're growing. They've got a great business model, and what we're seeing now is the growth regionally with them as well. So they're on an expansion.
And Yosh, is there a huge yield differential for buyers between Eljana's in New South Wales and Eljana's in Victoria or Eljana's anywhere else?
At the moment, it's fairly consistent across the board. So we've seen, we've traded obviously the Eljana in St Albans at about 4.97%. We've just done the one in Nowra at about 5%. We've done the one at Tamworth in that early 5% region as well. So it's really it's been fairly consistent across the market. Then obviously you've got Starbucks where we've seen some strong yields across the covenants. Where I think with Starbucks, what's interesting is the brand, because of its global presence, you do get a number of investors, even internationally or based in Australia, who know the brand from travels and whatnot, who have some form of comfort within the brand as a whole. Where we see Warrawong we sold at 4.65%. Our last portfolio we had a great auction of the Brisbane Starbucks at Deagon, which we sold at 4.59%. So, these really great cap rates achieved for some of these fast food operators and a really nice confidence of the market for well-established brands that are existing and known by a number of investors.
We've also brought to market, fast food in WA, Tasmania, South Australia this year. It hasn't just been the major markets of New South Wales, Victoria and Queensland. How did investors welcome and receive and respond to WA and Tasmanian fast food assets?
Yeah, and case study at the moment is KFC Riverton. It's still on the market, and we've been absolutely blown away by the inquiry. We're over 200 inquiries, which typically WA lags a little bit.
So tell me about Riverton. Where are we?
We're about 10 k's from the CBD of Perth. We're sitting out the front on a freehold title of almost 3,000 square metres of shopping centre. So it's a fantastic, again, fundamentally, property, location. It's a brand new 10-year lease to a listed entity, Collins Foods. They've just done a new fit out. Rent sitting at an affordable $225,000 or thereabouts. So we're closing that one later in this campaign, and I think that'll show us where yields have sort of compressed to in WA for fast food.
And land tax has been on a major topic all year in 2025, especially in Victoria.
Absolutely.
How is land tax treated at the Riverton property in WA?
It's fully recoverable,
Right.
by the tenant. So again, that's a point of difference. Again, we spoke about Victoria. It's been one of the harder things this year. So a lot of fast food tenants will pay the land tax, and that's a major point of difference.
What's interesting, fast food as a whole is probably got the most cross-border transactions that we see across all the asset classes. Because the Hungry Jack's in WA, New South Wales, Victoria, they look exactly the same, and they sell the exact same product. They're the same tenant, generally speaking, the same lease terms. And so we found a number of our investors who we manage property for, who own multiple of these assets, they own properties in every sector. This portfolio, we're going to have 9 freestanding tier 1 fast food assets. I can guarantee you one person's going to miss out on one and just go buy the other one.
And that's really interesting. Do you see that across other industries, or is that just fast food, or are you seeing that in fuel as well?
Oh no, definitely fuel. They're happy to buy in any state because if they know the they know the tenant, and the tenant's not going to go to a bad spot.
Yep.
The tenant is always key to these things a lot of the times, and they're always going to go on highway sites, good locations, visible.
And I would say this year, working all the auction rooms, I have seen a massive amount of bidder transference over the 3 days. So something that 2025 really stood out to me, that especially Victorian buyers are actually quite comfortable to buy in Victoria, but they're also becoming far more comfortable to jump the border, especially into South Australia with lower stamp duty, or into Tasmania.
Yeah.
Who's been buying the Tasmanian properties in 2025, Matt?
Yeah, and traditionally it's more local-based buyers that know the market, they know the ins and outs, they know where people are going and where they're not going. But we've seen an emergence of interstate and some international money come into Tasmania. So again, being comfortable with the brand and where they're going, I think it's been a huge year for new capital into Tassie.
Now, let's change pace a bit. Let's leave fast food and fuel and convenience for a moment, and let's go into early education childcare. Another incredible year for childcare this year. We continue to have great tenants joining the market. We have great properties. We have incredible quality of building. What's happening with childcare? Let's go around the states. New South Wales, Yosh, what happened with childcare in 2025?
Still continue to be a really strong sector across the market. We're pretty fortunate in New South Wales. Land tax is actually exempt in New South Wales for childcare. So it may talking about land tax. So we, from that perspective, it gets a lot of national attention from investors. And we did see a high transaction rate across the New South Wales market and yield compression. We sold the Vaucluse Childcare Centre for $6.5 million at a 3.3% yield.
Wow.
Probably the most prestigious suburb in Sydney.
I would ask if that's one of your sharpest yields, but I think you've actually done sharper in Mossman.
We did sharp in Mossman. We did sharp in Mossman at 2.75%. So that was one that will hold for a little while, I'd suspect. Again, another prestige suburb of Sydney. But when you talk about some of these really prestigious suburbs that have very high underlying land value, to have a land tax exemption on your commercial investment is amazing. Huge,
And is that only in New South Wales, or are we seeing that in other states?
It's only in New South Wales for the exemption. Yeah.
And Queensland also had some real standout results for childcare. I know we had some G8s, very, very sharp. Was that driven by the quality of the lease? They were very, very good recoverable leases. What drove those values?
So it was a mixture. So we had two segments of the market. So the overall childcare market in Queensland moved. We got definitely sharpened across the board.
Why?
So we had a number of interstate investors investing further north. Obviously, when they're in Sydney, paying sharper cap rates, where you're seeing things start with a 3 and a 4. Then we start seeing yield compression in Brisbane, where you're starting to see things in the early 5s, So, and then to be honest with my colleague Josh in Queensland, he's just sold one for 4.25%. We just did Ormeo for 3.96%. So there's two segments where we had some good start early learning childcares that were triple net leases, relatively under rented across the board. And so people were paying a sharper yield for those assets. Although there's fixed income, they had some really nice market reviews every 5 years, and it really drove some investor appeal in that regard, and it introduced new buyer profiles to that market. We had the Albany Creek Good Start, which sold really well as well at $7.2 million at a 3.96% return. Again, fantastic auction, similar type of asset where the rent was a bit under market, but very triple net lease, multi-holding land tax again on that side. So it was, I think it is certainly a segment of quality, but also a movement of interstate money moving north. I think the Olympics is also pushing Queensland in the right direction at the moment as well,
So I know the median yield kind of point for childcare sits between about 5 and 6%. I mean, what you're talking about are far sharper, but I think it still gives a lot of value to investors. For a long-term lease, high-quality tenant to still sitting in that, to be able to access assets in that range, there's some really, really good buying for people. What do you think is going to happen with childcare in 2026? Is it going to be similar results, or are we going to see a further contraction?
I think this will continue into 2026. I think certainly we'll continue to see interest rates play a contraction game on most asset classes, I think, across the market if interest rates continue to reduce. I think there'll still be a lot of interstate pollination between investors and product. I actually think Melbourne's going to see some, my prediction is Melbourne's going to see some uptake in some childcare sales. I think that market is yet to move as quick as some of the other northern states, and I actually feel like there's really good opportunity here. And I think there's actually an opportunity for investors right now to get their hands on some product where I think that market will move. because yields are sharpening in other states.
Love that.
And with construction as well at the moment, some of this stuff is below replacement cost.
100%.
You literally cannot go and rebuild what they've built.
Absolutely.
For the price that you're buying these assets for. And I think that's a theme that I've also seen in 2025. As construction costs went through the roof, and I know, Jamie, you talk about bringing warm shell fuel to market, how much more expensive it is. Fast food's gone up, childcare's gone up. These assets are actually providing better value as well. And then they come with new depreciation and long-term leases. Are we seeing a shift? Are the leases looking the same in childcare, or are they starting to also change? I mean, I know I've had some more triple net, for example. Is competition creating a different lease, or are they still staying similar?
The leases are, I think the competition is strengthening leases in general. I think the template lease for what everyone loves, the net leases that we all love to sell is there. I think the competition is certainly leading to increased rents. I think there is, we've done some leasing campaigns on childcare with our childcare specialist investment team, and that has driven some, some of these campaigns get a lot of offers on some of these centres. The market is so buoyant for new operators in that regard. So I think certainly the lease structures will continue they'll always continue to enhance in different regards, but I think rents will continue to move because we are seeing that across the board. Again, to your point, construction costs, but also the fact that the competition for some of these sites is pushing some of those levels as well.
And we still have an undersupply of childcare for the number of children forecast to be in Australia. So I suppose the other piece to that is the government is going to continue to support the industry. We know that it increases productivity. We know we've got bipartisan support. So I think those things together are also stacking up a really, really great investment. So childcare obviously sits within a much bigger vertical, which is social infrastructure and healthcare. Increasingly, an ageing population, increasing government expenditure, healthcare has been on the top of everybody's tongue in 2025. And we brought a large number of assets to market. Yosh, you bought the PRP portfolio. Why is a portfolio? Why do you bring properties as a portfolio? And what is it in it for investors? And how do you achieve results when you've got so many of them?
Yeah, so I think it runs down the same success line as why our auction portfolios are so successful. There is a lot of cross-selling between a number of asset classes. Talking about the PRP portfolio specifically, phenomenal tenant. Backed by a significant business, IFM. There is a underlying security there for tenants because the actual fit outs are incredibly sticky. There's one of the MRI machines in one of these buildings is $2 million. Do you know what I mean? Like it's a lot of expenditure to go buy some of these.
And that's just the machine. The walls are lined in lead.
They're hard to move. To be able to get approvals to actually get these medical facilities in these locations is very difficult. And often they are little landmarks. People know, I know where my local GP is. I know where my radiologist specialists are if I have to go. So there is these locations that are synonymous once they actually bed themselves down. The PRP portfolio across the board performed exceptionally well in that regard. We've got another 3 coming to market, this portfolio, which is going to be great in Shell Harbour and Westmead and Bathurst. And as well, we've got another development opportunity there at Gosford. So we're really excited to see how that performs. But across the board, coming to your point about aging population, I remember doing inspections at all these sites, and it was, as hard as it say, it's full. It was unbelievable.
We know we have an undersupply of healthcare services in Australia. We have undersupply in regional areas. We have undersupply of staffing, facilities, locations. It is something that the government's going to have to turn their mind to, and this stuff's already in place and ready to go. So the underlying asset is great. What's interesting? We spoke to the CEO of PRP, and he told us every single property is profitable. That's incredible. Every single property, and it ranges from a variety of different sizes, every single site. I think it really talks to the profitability of these sites in general, but certainly the long-term tenure. A lot of these sites as well, talking about strategic locations, sat in front of hospitals in key medical precincts. One site in particular that was very exciting for us was the PRP in Blacktown. I would go to say that this is probably one of the best Sydney healthcare investments that has come to market. And actually, that wasn't actually my words. It was someone. There was actually a few funds that had told me that. But I believe it as well. We sold that for $19.55 million at 4.97%. Phenomenal building. We talk about replacement costs. That asset's replacement costs is humongous. It's incredible.
100 basement car parks, PRP occupied majority of the building. It had a medical centre, rehab facility, dermatologist. It was actually an amazing medical investment.
But within the healthcare realm, we've also got vets, we've got dentists, we had animal hospitals this year in Waverley. Matt, talk me through the Victorian market for health. What kind of assets are coming to market and what's going on with yields? Are we sharpening? Are we stable? Where are we at?
We are, and I think a really good point was the Vision Radiology portfolio we recently put to market, and the one was probably in Melton. It was an end of a lease, so we actually got involved with our leasing specialists and put some competitive tension on it. So the fact that 4 individual brands came forward and drove the rent up, it sort of set a new benchmark for a market rent. I mean, that is the definition of a market rent, competitive tension, and we reset it. But that result was phenomenal. I think we saw a sub 5% yield on that. And so I think we're seeing yield compression in Victoria, which is fantastic. Growth corridors, we're seeing a lot of these come to market where houses have actually gone past these medical centres, so they're in established locations. And as you said, very, very profitable. They've got long-term trading history there from clientele. And I think that's probably one of the biggest things you see with medical, where you see families actually go down the line and they continually go to the same clinic because it's familiar. So this campaign, we've got a couple of medical centres coming to market. I know I've got a smaller one coming to market in Benalla that's been there for 25 years. Price point wise, I think it's going to go bananas. It's sub $3 million. So I think it's very, very affordable. There's a long-term lease there. It is regional, but they've got a build-up catchment there as well. So we've got some really exciting stuff coming to market this campaign.
I think you make a really, really good point about price point. I think that, across the whole portfolio in 2025, we've sold assets as low as $500,000 and as much as $35 million. Would that be? So I think there's something for everyone. There's a lease for everyone. There's a risk profile for everyone. Talk to me about, though, obviously we've also got emerging areas, and you've seen Victorian investors being very interested in South Australia and Tasmania.
Yeah.
Talk to me about Tasmania in 2025. It seems to me like there was an influx of really high quality property. What happened? What's selling in Tasmania?
Yeah, I think Tassie's been in the news. It's probably been in the news for positive reasons and then some negative ones with the stadium, but hopefully that gets through. But I think over the last 5 years, talking a little bit further back, Tassie's gone through this new image, and it's probably around greenery and food, and it's the place to go to. And I think the tourism part's driven a lot of people to go down there and go, hey, this place is actually really, really cool. So investment-wise, we've seen it become more familiar. So when we're talking about it now, people are actually more educated on it. So it's been growing for the last 5 years. Fortunately, this year we brought some really quality property to the market that's helped, some quality brands. And not only Hobart being the capital, but you've also got Launceston as a second capital and then Devonport. So I think you can get some excellent value in those regional cities, and that certainly happened this year. But our favourite one was probably the University of Tasmania.
I was going to ask you about that one.
Yeah, and we were very, very lucky to bring that to market on behalf of the university, but it was the last whole city block, effectively, that we put to market.
Price? What did it go for?
It was north of 30. Wow. Still under confidentiality, but I can tell you that. It was north of 30, under 35, but north of 30. And we sold it to a Brisbane-based investor/developer who we're not entirely sure what they're going to do, but they've got some amazing plans to
And what was the buyer depth like on that? Like, did you have a lot of people interested in buying a $30+ million asset in Tasmania? Yeah. What was it like to deal with that? Did you have a number of bids? How many bidders were there?
Yeah,
investors' inquiry?
Yeah, we ended up with 4 official bids on contracts. So I think out of that price point, that's a very good result, probably even nationally, depending on the asset type. So to have 4 unconditional offers on it was amazing. Inquiry levels were mixed, and that was really interesting. We had some people inquiring to, can I buy half of it? Can I buy a quarter of it? Can I build some residential on it? Can I do this on it? So filtering through all that, I think we uncovered a whole new range of investors or property people that are looking in Tassie, which is exciting too, moving forward for next year.
So overall, in 2025, we've seen yield contraction, better quality leases generally coming to market, and we've seen a full range of prices. $1.7 billion in 2025, $3.268 billion across all of CBRE Metro sales. It's been such an incredible year. Pretty exhausted, but we've still got December to go. $370 million worth of properties, 69 incredible assets. I'd like to thank you all for being here today and sharing this moment with us. I wish all of our investors, clients and stakeholders a very happy and safe holiday season.